I want to get more on the global economy and the markets. I want to bring in Legg Mason, Senior Vice President and Fund Manager, Robert Hagstrom. Robert manages $2 billion and actually wrote the book, The Warren Buffett Way, Investment Strategies of the World's Greatest Investor. He's live from Philadelphia this morning. Robert, good to see you. You've said that in a career spanning some 25 years, this is the easiest analytical time that you've ever had because stocks are so mispriced.
Yeah, Maryam, I think, I call this kindergarten investing. This is about the easiest mathematical way for an investor to get involved in the stock market that I've ever seen in my 25 years. Now, psychologically, it's a different story, but mathematically, it's very easy.
So which industries are you focusing on? I mean, whereabouts do you think the attractive buying opportunities lie if everything's looking so cheap?
Yeah, well, I mean, clearly the U.S. mega cap stocks, and that's kind of a crowded conversation. I know everybody keeps talking about the big cap multinationals, but it's not the crowded trade because these stocks are very, very cheap, both on dividend yields, on earnings, and things of that nature. But if you look at them as investment opportunities over the next 3 to 5 years, I don't think you've had a more appetizing time to think about these stocks than you do right now.
All right, I'm just thinking about some of the eco data that we've had out this week. I mean, apart from the fact that sentiment in general has deteriorated to such an extent, there are concerns about high unemployment, initial jobless claims, manufacturing, contracting industrial activity. How does this erosion in consumer and business confidence impact these huge blue chip multinationals despite their strong balance sheet, strong cash flow?
Well, Maryam, I remember, I guess, in my career, it used to be just-in-time inventory, and now we have just-in-time employment. The most recent thing that's happened in markets is now we have just-in-time attitude. The whole risk-on, risk-off that you see that's affecting stock prices is really a short-term strategy. People are trying to make money over a short-term period of time. But if your time horizon is more 3 to 5 years, the signals that are very powerful to you should be things like the valuation, the dividend yields, the growth of dividend yields that are out there that are substantially higher than the 10 years. The short-term data is noise to the long-term investor, and I think you need to separate those two.
You just want to check in on what U.S. equity futures are doing, bring you up to date with what's going on there, because we're seeing really all the same concerns playing out right now. We're seeing futures really extending the lows that we've seen, showing that the S&P may post a fourth week of losses. And I guess when you look at this, Robert, and you look at what's happening in the market from at least a psychological viewpoint, it's difficult to maintain the kind of optimism that you've described because investors are looking pretty much turned off from the stock market right now.
Well, I mean, Maryam, you said exactly right. If you're a short-term investor, it's a very anxious time for you to try to figure out what to do over the next several weeks, several months, several quarters. I would agree with you. The anxiety is extremely high for short-term traders. But for long-term investors, and remember, there's two strategies out there. You can make money over the next several quarters, or you can make money over the next several years. For those that want a long-term strategy, which should be a part of your portfolio, it is very, very easy to be invested in the stock market right now.
Robert, timing is important. Yesterday, the S&P held off lows that it set last week, both on a closing basis and an intraday basis. Futures suggest that it's going to at least blow through the closing low of last week and may, if the decline extends the way that it did yesterday, blow through that intraday low. What happens then? Do you wait to get in because the psychology is just getting so vicious that further declines are in store?
Yeah, it's going to be tricky today. We've got options expiration. Obviously, there's a lot of anxiety in the market. But if I was going to make a bet that I wanted to pay off over the next 3 to 4 to 5 years, I'm not sure I'd really be too concerned whether I bought today, bought next week, or bought 2 weeks from now. The returns are going to be more magnified over that long-term horizon than it will be over the next 2 to 3 weeks. But remember, that's a long-term strategy.
So Robert, just a quick one actually on the companies that you're liking right now. This is interesting. You're into companies like Cisco Systems, Abbott Laboratories. Why? What's your thinking there?
Well, we're really more into the dividend players. Cisco's dividend is not as high as we'd like. We do own it in our growth fund, the Legg Mason Growth Trust. But what we look in our portfolio that's most impressive to us are things like Abbott Labs, things like Minnesota Mining, Johnson & Johnson, Pepsi, Procter & Gamble. These are stocks that have almost 3% dividend yields, in some cases higher than 3% dividend yields, and they're growing at 10% per year. In 7 years, you could have a 6% return on your initial investment. Think about having a 6% income stream coming at you over the next 7 years. And then let me say this, Maryam, and if I can leave you with one thought. These companies that I just mentioned have over 50% of their revenues coming from outside the United States. And if I leave you with one impression today, it is that the S&P 500 is no longer correlating to U.S. GDP.
Okay, Robert, I just want to touch on a point that you were making in terms of what is driving the markets right now. How much of an impact are the economic fundamentals, real GDP growth, going to have on the markets going forward in the next few months, particularly if we do get closer to the precipice of a recession, as many have been predicting?
Well, I think it's very important to keep what the information you just gave to investors in context. First of all, the Citi report will tell you that they're not forecasting a recession. They're saying 1.6% this year, and they're actually saying growth will be higher next year at 2.1%. I also love the and read in detail the Morgan Stanley report. When you say dangerously close to a recession, the end of that statement says, but that's not our base case. So they're saying, yes, you know, if you look at the risk dashboard, it's flashing caution. We're slowing down. But nobody is saying there's a recession in the U.S. Nobody is saying that there will be a global recession. And more importantly, if you look at the global GDP numbers, they're looking like 4%, 4.5% for next year, for the next 12 months. If the U.S. economy was growing at 4.5%, everybody would be thrilled.
Robert, I wouldn't say nobody is calling for a recession. There are a few voices out there, including Marty Feldstein of Harvard, saying there's a 50% chance or better that we're going to be in a recession. The question I have, and you need to sort this out every day, is why is the market getting it wrong? The direction of stock prices, the yield on the 10-year Treasury, the 30-year Treasury, which has been moving at an extraordinary pace the last few days, gold almost at $2,000 says something about the economy, and it sure feels like recession.
Well, I mean, you have to look at the stock market. The stock market gives you signals. The question is it the right signal or is it noise? And then the question is, what is it discounting? And then whether you believe that discount is right. But let's be very clear. The market is notoriously bad at predicting economic recessions. Imagine your best friend had the same track record that the stock market does in predicting recessions that your friend did in picking NFL games. If his pick came up on Sunday, would you bet a lot of money on his picks if he had the same track record? The answer is no. So I think we have to keep it all in perspective that the stock market is very volatile. Sometimes it gets it right, but a lot of times it gets it wrong.
Robert, I want you to pick up on a point you were making a few minutes ago about what the S&P is trading off of, and the point you were making about the correlation or not to the U.S. economy.
Yeah. Well, psychologically, people have a tendency to equate stock markets with what's going on in their own economy. If you feel good about your economy, you feel good about the stock market. But the facts, Erik, are that the revenue stream of the S&P 500 now correlates more closely with world GDP than it does with U.S. GDP. So you really have to focus your attention on what's going on in world GDP to get an accurate reflection of the health of the S&P 500.
Now, how about dividends? Just a quick note on dividends before we go. We've spent a fair amount of time talking about them, but for how long can the dividend yield in the S&P 500 exceed the 10-year Treasury at 2% or less?
Well, it depends upon the direction of the 10-year Treasury, right? If the 10-year Treasury stays down below 2%, then the S&P, I think, has every chance of staying much higher than the 10-year. And one of the things we want to keep in of the three constituents out there in the growth, which would be the consumer, the government, and the corporations, corporations have never been more healthy than they are today. Look at share repurchase programs. We're at record levels this month on share repurchase programs coming out. Dividend yields, balance sheets. These are the warriors out here, or the U.S. multinational corporations. That's where I'm putting my money.
Okay, but there's one point to make there, Robert, which is that, yes, companies are using cash, buying back stock, raising dividends, and that may continue for some time. But it's because they don't have anywhere to invest that cash. If they can't invest in growth, then the return to shareholders at some point has to slow, does it not?
No, you're exactly right. But then let's ask ourselves, where are they investing their money? First of all, they're making more money right now than they can actually invest. But they are investing their money, and they're investing their money in emerging markets. Emerging markets today represent 80% of world GDP growth. So if you go to Minnesota Mining, you go to Pepsi and Procter & Gamble and ask them, where are you putting your money? They're putting their money as fast as they can into the emerging markets responsibly. They can't get it all in there. But that's going to be a long runway of growth, of unit growth, consumer growth for multinationals is what's going on in emerging markets. And that's going to last for a very, very long time.
Robert, very good to see you on the Inside Track and sharing your insights and your optimism with us this morning. Robert Hagstrom, Senior Vice President at Legg Mason. He's a portfolio manager there.